You're welcome to the mathematics of trading plan development, how to use numbers in your favor. In this lesson, I am going to be showing you how to use mathematics to work things out to favor you as a trader. The question that might be on your mind at this time is, why mathematics of a trading plan? And the simple answers can be that mathematics of a trading plan is an aspect of trading plan development that many are so reluctant to give quality time to if ever they do. So if you understand this, you are going to be one of the few that pay attention to the developing plan aspect that may deals with numbers. Many traders would rather just tell themselves how much they wish to make in trading a period, a day, week, month, or year, and they just move on from there without necessarily taking time to go into the details to plan and prepare their minds for whatever the market will bring. And incidentally, understanding the mathematics of a trading plan is the crux of successful trading, and it holds the rest of the plan together. So now, before we move on, there's need to understand the components of a decent trading plan, and they include your trading goals, your trading systems or method, your trading mindsets, your trading routine, and of course your trading journal. What is trading plan development? Trading plan development is the building of the roadmap to your trading destination. It is the bedrock of most successful traders. It is the putting together of all the components that make for success and driving them to achieve your trading success. Remember that your trading plan is your guide to successful trading. It tells how successful you can be at trading over a given period, even before you start. The mathematics of trading plan development. This focuses on trading goals component of the trading plan. It deals with the numbers. It is the tool that helps you determine how the numbers fit together in your trading plan. Mathematics of trading plan development is the tool that helps determine your financial involvement in trade you take over a determined period, and the tool that helps you determine your potential risk and reward for every trade and over a predetermined period is the mathematics of trading plan development that we're talking about. It also helps you to determine your position size per trade. The mathematics is the aspect of your trading plan that involves working with numbers. It is using figures to figure out how you trade each time you trade. You begin with the yearly trading goal in numbers and then break it down to per trade per day basis. What you need to know about your goals and account sizes. First, the smaller your account size, the more likely your goal target will be bigger in the percent. That is, it is easier to achieve a 120% growth in an account of $30 in 1 week than it is in a $1,000 account in 6 months. Your account size is the leverage you choose. The bigger your account, the lower it should be your leverage, and high leverage on a large account size is an invitation to greed and disaster, I must say. I can manage 1 to 1,000 leverage on an account of say $10 to $100 bets, not on a more than $1,000 account, because it can be blown up in a jiffy. Why you need trading goals? Your trading goals help you to keep focus and guard against distractions. It helps you to control your trading frequency and reduce overtrading. It helps you to measure performance easily, and of course, with your trading goal, you are better off than many who do not even set any trading goals. Now, let's look at the yearly to daily trading goals. On a $1,000 account and also on a $100 account, what do you expect per year? What do you expect per month? What do you expect per week? And also, what do you expect per day? We'll look at these one after another, and we'll begin with yearly to daily goals on a $100. Now, on a $100, we can target 120% account growth per year, and this can be easily achieved, I must say. It's so easy to achieve this if you follow the plan I'm detailing out here now using this mathematics. Alright, now risk reward ratio will be 1 to 2 minimum, and therefore we're going to be risking 60% of $100 per year. That's about $60. In other words, if the worst comes to worst, you will lose $60 of your $100 in trading in the course of one whole year. Now, monthly risk, of course, is going to be having us divide the $60 by 12 months, which is $5 per month risk. And weekly, divide $5 by 4 weeks, giving us $0.42, that's 42 cents, which is less than $1. And of course, daily risk, if we just take only one trade per week, we will be risking only 42 cents per day, per week, per trade. Now, when we move on to determine our position size using this scenario we've just painted, and I always recommend a minimum of 50 pips, a maximum rather of 50 pips stop loss. Now, if I see 20 stop loss, splendid, I will take it with good risk to reward ratio. So to determine my position size, I'm going to divide the amount of risk by the SL, and that is 42 cents divided by 50, giving us 0.0084. Now, if approximated, it will give us less than 0.01 lot, which is 1 cent a pip, meaning that this account is trading on a cent account. So if you take position size 0.01 at 1% pip, that is what we'll be having. When you win, when you take a trade and it's 1 pip, it's 1 cent. Okay. Now, if 20 pips SL, will be having 0.42 divided by 20, in which case it will give us about 0.02 at 20 cents, which will be 2 cents per pip. Ignore the 20 there, 2 cents per pip. Please ignore the 20 cents, there should be 2 cents per pip, not 20 cents. Okay. Alright, now yearly to daily goals on $1,000. I can also say that it's easy to achieve 1,000% account growth on $1,000 per year. Alright, I'm not saying per month, I'm saying per year. That's 12 whole months. Now, risk reward is still 1 to 2, and then per year risk will be 50%, which is about $500, and then monthly will be 41.67. That's dividing 500 by 12. Weekly will be 10.42. Daily will be, now if you take 3 trades per week, daily will now be 10.40 divided by 3, 3.47. Now, and per trade at 50 pips SL, our lot size will now be 3.4 divided by 50, giving us 0.07 lot size. But if we go by 20 pips stop loss, we have 3.4 divided by 20, giving us 0.17 lot size. Okay, now this will be 17 cents per pip in this case, while the other one here will be 7 cents per pip. Okay. Now let's calculate the profits and the losses. Let us use the $1,000 scenario. With 50 pips SL and 100 pips TP, we'll have a profit of 100 multiplied by 7 cents, and that will be giving us like $7 per trade in profit, while the loss will be about 7 cents multiplied by 50 pips, giving us $3.5 for risk. And if we have 20 pips SL and 100 pips TP, we'll be having a risk of 17 cents multiplied by 20, giving us $3.4 versus a profit of anything between 8.5 to $17. That is if TP between 50 to 100 pips on 20 pips SL. Okay, so let's look at it in practice by quickly going to the trading platform. Now look at it here. In here we have 1,000, and if I'm picking the trade here using the scenario we just printed. Now let's see, look at this for instance. There is kind of a signal here. This is a hammer, and to take any trade, assuming I come down here to say, okay, if you test here, I'll buy, alright, or I want to sell here. Okay, now let's say I sell here. So what I do, I take the crosshair and look at determine the risk involved. Remember, I'm working with 0.17 to as low as 0.02. Now 0.07 rather, if with the $1,000. So let's say I place a sell here at 1.6511. Now what this implies is that I use my stop loss around here, that's 7 pips, so meaning I can actually set as little as 20 pips on this. Look at this. So if I take it here, 20 pips, alright, or I say I want to wait for it to rise up to this point and I sell here, around here, okay, and then my stop loss around here, 20 pips above here, that's around 1.6562, while I sell at 1.6542, 20 pips. So, and it's worth it, then the TP can fall down to, as from the analysis I did already on this, if it sells here, then TP can be as low as 1.6435, which is around more than 100 pips. So if I go with that, of course I'm going to work with 0.17. So I move this 17 and then I set it up. So if it goes against me and I lose the trade, I'll be risking $3.4. If you know what I mean, I'll be risking $3.4. But if I win over 100 pips, I'll be looking at 17 or more than that in that one single trade. So that is how this works. Now, if I work with this, if this will return to this place and I decide to sell up here, now let's switch this. I'm just looking at for those who do cherry picking and trading. Alright, and this returns back here. Let's say here, I pick this. Let's say I sell here, 94, and then I put the stop loss around here or here. That's about 20 pips, 6514. That's 10 pips, and I target 35. If it goes down to as low as 6435 from 94, let's look at this here. It's still not seen. Okay, just move it like from 95 to look at this. Let's say pushing up from here 95 to here 20 pips, and then down to 35. That's just like 60 pips. Okay, with 60 pips, so what we'll be having in that case will now be, if I just multiply it out, I'll have 60 pips multiplied by 0.17, and that will be giving us around $10.2. Okay, so based on that, it's a good one to also take. So with this, I'm able to determine my risk reward. But how about if I say I want to sell here and the stop loss is around 50 pips? I want to sell here, for instance, and the stop loss is around okay, let's stop loss is around 33 pips here. Okay. Okay, now remember something. I do not want to risk per trade, knowing that per trade here, this is like going to be for 3. Let's look at this. I think you're looking at, okay, 3 trades per week. Right? Yes. So 1 trade per day. So if it's just for this day, 3.47. So if I push it here to say, okay, let's say I sell around here and my stop loss is 35, let's say 40 pips. Okay, 40 pips. That means I'm going to be multiplying. What lot size do I have there? Just look at 40 pips divided by that's a 3 point. What do I have here? Look at it. Oh, looking at 3.47. 3.47 divided by 40 pips, and we're looking at 0.086. So it will make me reduce my lot size to 0.06 alternative. Now that means I'm going to be dropping it down to 0.06. Okay, 0.05. Okay, 0.86 or 0.9. I just appended 0.9. So I'm going to go with 40 pips. In which case, if it wins TP, because at that point my TP will be so low, so I may not even want to take such opportunity because it will reduce my reward. So instead, I'd rather wait for it to pull back up here, and then I join and reduce my risk and increase my potential of gain. So this is how the mathematics of trading plan development works. Now I will wait for you now to ask your questions. and I'll be taking your questions. So let's go. Type your questions and I'll be answering you as I read your questions.